Sometimes you've seen me show trades where I get in and I'm not really trying to move my stop loss. I'm taking partials along the way, but I'm not really trying to rush my stop loss up. I'm going to show you the rules I follow so that way it makes sense to you, and it'll help you also trust taking partials, letting that become a better way of managing a position and trade, and not be fearful about being stopped out, because the stop loss is there to do its job. You pay it well to do that. But if you're worrying about that stop loss being tripped versus following along in price action and continuously measuring whether or not price is giving you what you're expecting in terms of bullishness or bearishness, is the institutional order flow still bullish if you're long, or is it still bearish when you're short? Those types of things are more important than worrying about whether you're going to get stopped out or not. That's not to minimize, obviously, the risk that's respected. Obviously, you should be respecting the risk by actually putting a hard stop in. But if you don't put a hard stop in, you're not really respecting the risk. What you're saying is I'm risking this trade because I believe I'm right, but if I'm wrong, I'll figure out where I'm wrong when it gets there. You don't want to do that. Okay, so anyway, we'll close that portion of the discussion at the end of the video. But here, it's a 2-minute chart showing the afternoon or PM session for index futures. And you can see we traded down into, this is showing a weird time because it's 2 minutes, but this is the 1 o'clock hour. It hits the low and then starts to rally up. Short-term shift in market structure here. Key time of day, 1:30. It trades back down into an order block, last down close candle. There is a fair value gap right here. I didn't note it because it's going to be too cluttered up, and I'm going to be basically doing a lot of discussion in this area, and I don't want it to be overlapped with too many things to be navigating. So this is the 15-minute fair value gap, and it's trading down to an order block after a shift in market structure, after trading down and closing in a 15-minute time frame. Fair value gap. And then it trades into an optimal trade entry, which is the flagship pattern of this YouTube channel. Fair value gap with an order block and optimal trade entry is the gold standard of the ICT pattern that's taught on this YouTube channel. This is where you can be long and expect price to reach for here and here. Okay, so we have objectives in here where we can look for this imbalance here, buy side liquidity here, buy side liquidity here, and we'll watch and see, does it continuously march higher? So we have a run from here to the short-term high. Then we have this fair value gap here that runs here up into the 3805 level. So this PM session I was long in, and I'm not going to try to build the case to outline everything because I want to give you what's salient to close this mentorship and show you how to use stop placement, risk management, and give you a working example. And you'll see what it means to go through the process of determining risk management and stop loss placement and when you move your stop. All right, so we're zoomed in here and looking at the 5-minute chart. And again, that's the fair value gap we're going to be using here to frame it. So if you're looking at the idea of you traded down into that fair value gap, does it show willingness to go higher? Yes. Is there a short-term shift in market structure? Yes. Is there a gap? Yes. Down close candle to the left of it? Yes. Drops down in, bullish order block, optimal trade entry. In other words, that would be a 62 to 79% retracement level, less than equilibrium relative to the high and the low, respectively. So we would be looking for a limit order to be at 37.5475. We'll use that. Okay, so 1/4 point less than this candle's low. So that would be our hypothetical limit order to buy going long, and we have to use the low here for our stop loss. So 37.45.75. Essentially 9 points of risk. Okay, so we'll come back to that in a couple of minutes, but for now, what we'll be reaching for, what will be the draw on liquidity from this high down to that low, We want to get to a premium level. 50% is about right in here, eyeballing it. We don't need to have a fib on that. You should do it for yourself. But then we have this imbalance here. So the first low-hanging fruit objective would be this candle's high. That's 37.80 and a quarter. So we're looking at about 25.5 handles of potential points profit per contract. So we're risking 9 points to make 25.5. Not bad. It's better than 2.5 R. So you're going to risk $1 to make $2.50 basically. And that's on a run from here to here. We don't need to know if it's going to go up to here yet. Okay. This right here is one trade from here to here. Then it creates another opportunity in here where it can run from here to here. And we'll talk about that when it gets into the discussion on risk management and trade management. All right, stop management. And this is going to close the mentorship in terms of the teachings. And past this video, I'll be doing obviously reviews and topical studies when I feel led to do so. But as far as the model itself and the mentorship, okay, for YouTube, this free series I did, this is done. And you'll have everything that you need here. I'm confident in saying that what has been provided to you after this discussion here, you have enough. And obviously the things I taught you on the YouTube channel and other lessons, and maybe other future lessons I might do, they'll just be amplifications and help you refine what this has already given you freely. But stop management, okay, when you place your stop loss down here, when can you and when do I move my stop loss? Well, you have to determine where you're getting in at and where you're trying to get as a target. So that's your range from 37.54 and 3/4 to 37.80 and a quarter. So technically 25.5 points. Okay, so what is that? 12 and 3/4 points, something like that. We'll just round it to 12.5 points. If we see price move 12.5 points above the entry point that you entered at, if it moves 12.5 points, your stop loss can move 25% up. From where? What's 25% of what range? Where your stop loss is and your entry. So split that range in terms of points. If this goes up 12.5 points, which would be 50% of your expected range, then your stop loss can be reduced or trimmed down to 25%. So it's going to give you that little bit of a cookie, that feel-good moment. You trimmed some of the risk. You're not jamming it up above to break even because you're going to worry about it. You're just moving a little bit. Now, when price moves to 75% of the expected targeted range, and it means from your entry to here, if it moves 75% of that, then the stop goes to break even. Period. There's your systematic movement of your stop loss. You're not jamming it to break even. You're not going to be worried about getting stopped out. You're going to be more likely to be watching, does it still keep reaching for your objective? Do down close candles keep supporting price? Does it run below short-term low and run higher with a lot of energy because it took short-term sell stops out? Is it dropping down to a fair value gap and reaccumulating and sending another higher price leg higher? That's what you're watching. That's the things that you're looking for. And as long as it's doing those things collectively or individually, you are on one side. That means you're on the right side of the market, and keep holding for your position to hit target. If you are doing multiple positions, say you're doing competition level leverage, and for me that's anywhere between the range of 3% to 4.5%, then you're going to be looking to take partials. Okay, and that partial might be, once it goes 20 points in your favor, you have a static number. It always hits 15 or 20. Once it does that, no matter what you're doing, you take something off. Okay, that's something you might want to incorporate in your own trading model as well. But that part is for you to determine. Don't let me give you static rules that are considered, cast in stone, ironclad, can't change it. I hate doing that with my students because it takes away the uniqueness, the individualism that you're bringing as the trader to your own model. So these are just basic foundational points that I think will serve you well, but you're going to obviously evolve and come up with better ways that meet your expectations and also fit your personality. All right, so risk management. Anytime you're trying to consider what lot size or how much you're supposed to be trading or whatever, there are free tools if you Google them. Okay, it's amazing how many folks ask me and other educators out there the most simplest questions that are answered just by a Google search. Okay, I know it feels easier. I think it's a matter of just getting a personal response from the educator or whoever it is that you're asking. And it's not possible for me to go through every single person's question and reply to them. So hopefully you understand that there's just simply no way for me to do that. I don't have enough time in the day to do that. Nobody really does. But simple things like lot size calculators. Okay, you can do a Google search on that, and there are some wonderful free applications and tools that will make that known to you by you just plugging in how much money you have in your account, what risk percentage are you trying to use, what size stop loss are you going to use, and it'll tell you how much leverage, if you're trading Forex, or what your lot size should be for futures. Now, I understand that's probably not the response that you're wanting, because you want to have an interactive experience with your educator or mentor. But these are really basic types of things that could be learned and understood and found the solution to by simply doing a little bit of the legwork yourself. With that said, I'm going to give you one example here and just kind of like walk it out for you. Assuming you had $10,000 and you're trading index futures, and you are using this trade idea that I'm outlining here that I was monitoring in the afternoon session. $10,000 is your equity. You want to take 1% risk per trade. So you're going to take that $10,000 times it by 0.01. That's going to give you a figure of 100. That's $100. That's what 1% of $10,000 is. That means that's the total amount of risk that you're willing to assume. We determined from the hypothetical entry of your demo account at 37.54 3/4 and a stop at 37.45 3/4. That's 9 points or 9 handles. Okay, that's what that 9 is. So we're taking the dollar amount, which is the 1% of our equity, giving us $100 or 1% of $10,000. Total movement that we're willing to absorb as a risk or a stop loss is 9 points. So we take 9, divide that into 100. That gives us 11. Okay, 11 times we can get the figure 9. That 11, if we're going to trade a mini or E-mini futures contract on the S&P, the multiplier per contract is $50. So divide 50 into 11. You can't. So you right away you can't trade a mini if you're going to be risking 1%. So you have to drop down into the micros. So now we have 11 with the multiple of 5. So a micro lot on E-mini micro, instead of $50 per point, it's $5 per point. So how many 5s can you go into 11 with it? 2. So you can do 2 micro lots. Now, this might not be for you, because when I do risk management, I don't really factor in commissions. I'll just do the math like this. So you might look at that and say, well, what about commissions? That might not allow me to do 1%. If you're going to be very hardline about the risk management, and I get it, some of you should be like that in the beginning. But as you get more experience, you'll start thinking, oh, well, the covered costs of commissions and such, over time, that's fine. I'll work that out. But for risk management, just for the entry to stop loss, not factoring commission costs and fees with your broker or spread, okay, all those ideas need to be considered. But we're going to assume that they're not going to be considered for this example. You have to figure that out on your own if that's how you're going to do your risk management. But for me, I don't ever factor in the costs, because costs are always going to be, they're like taxes. You can't avoid them. So just, you eat it, okay? So you can do 2 micro lots at $5 per point, making profit or taking in drawdown or loss per point fluctuation. So if we're buying at 37.54 3/4 and we're risking 9 points, How much money is that? $90 risk. So we're under 1%. So we're not even risking a full 1%. Our target is 25.5 points, or $255, because 2 micro at $5 at the multiplier of each point. 2 times 5 is 10. So you're making $10 per point because you're holding 2 micros. So 25.5 points here at $10 total multiplier based on the 2 micro lots, which would be basically 2.25% return. So you're going to risk 1% to make 2.25% on one intraday scalp here. And then you have another one here. And if you were trying to do shorts over here, you could have done something equivalent to that as well. So it's not hard to make 1 to 3 to 5% in one day with intraday price swings. The problem is you're going to get overexcited and think that you can do every single fluctuation in price action. And these types of movements, while they're exciting when you do the math on them and you see the potential, a lot of times people will say, well, 1%, I can't make money with 1%. Man, you can make a lot of money with 1%. Okay. If you can make 1% a day, that's enormous because that compounds over time. And it's not a matter of saying, well, if I make 1% a day and I do that Monday through Friday, that means I made 5% at the end of the week, or 20% for the month. Correct? That's what most of you are probably thinking right now. When in fact, you're actually able to get 22% a month because of the effects of compounding. If you do 1% per day, trading Monday through Friday, 4 weeks average per month, one could make 22% a month. Now, 22% a month is phenomenal. Like, that's ridiculous rates of return. Professional money managers and fund managers don't try to do that for a whole year. Some of them do anywhere between 12 to 15% a year, and they call that a stellar year. And if they make 20% or more, that's a blockbuster year. And they're parade around in front of their clients, they see that type of return and bolster their confidence to put more money in. That's usually when they'll say, hey, you want to allocate more money, because they get paid to do that. Well, 1% is, in my opinion, obviously, it's not going to be the case for a new student or a new trader, but in my opinion, 1% every single day is unrealistic. But for a seasoned trader, 1% average per day is really easy. But you're going to have to get the experience to do that. And again, that also equates to the average of 1%. So in other words, if I have one trade a week and I make 5%, that's equivalent to 1% a day for the week. I'm not going to sit in front of the charts to try to make 1% each day. It's not reasonable for me. I have things I have to take care of. I have businesses to run and family to tend to. And I can find setups that I can frame and make 5% on one setup, or first partial of a trade. So it's a matter of how you're going to form fit this for yourself. Okay. And obviously the best scenario would be, if you're going to be eventually getting to the point where you can risk 2%, you can do this framework for one limit order to be buying at 37.54 3/4, use the stop as explained here, and do a second order the same way, but don't use this as your profit objective. Use this short-term high here, or the target I was outlining, 38.05 and a half. And then you would be able to get a run from here to here on one that would close out. And then the second one would hopefully run up in here and get the daily range. And you can do obviously better than 2.25% just on this one. You'd have 2.25 twice, because the one that you bought the one you bought here that got out here, that's your banked 2.25% hypothetically. Then the second one would be running here and then rolling through that level up to here. So you could be making as much as 4.5% more on the second position. So what are you really making? 6.75%. One day, 2 orders, 1 trade. And a lot of you guys are trying to do those funded account challenges, and they give you you got to make 10% to do this and that. If you learn how to trade and you learn what I'm teaching you, folks, listen, those numbers are achievable, but you have to know what you're doing. And also how to weather drawdown. Drawdown would be having your account reduced from either its starting balance, or after you've made equity increases, you start taking losses. That's drawdown. Well, that drawdown has to be managed. So if you have a trade, and for instance, say you took this hypothetical trade here with one order, and you got in at that 37.54 3/4, and you got stopped out down here. Okay, you would have taken less than 1% loss. So your next trade, you should do half of 1%. Why? Because number one, you have emotions, psychological impact of taking a loss. You're going to be most likely wanting to have revenge, and you're probably going to want to do more leverage than you should, and you're probably going to want to get it faster than you should. In other words, being patient is not going to be the right thing for you. You're going to feel like impatience is eating at you, so therefore you're going to have to hurry up and get right back in there and try to get your money back. And that is a loser's cycle, gambler's mentality. So by reducing the risk on your next trade, once you take a loss, then you have to make back 50% of what you lost. So in this case, if you would have got stopped down here, we'll just round it to $100 with commission. You have to make $50 back before you can go back to your full 1% risk. And it's easy. That's easy to do. It's not easy to follow this logic. So what happens if you take that second trade and risking a half of 1%, and that trade gets knocked out to a loss? What size do you use on your next trade? 1/4 of 1%. And that's obviously the lowest you can go with. So you have to determine what your risk is, and it's going to obviously reduce the number of trades you can take. That's why I tell everyone, there's a lot of you out here that are starting on a shoestring, meaning you don't have a lot of money, and you're trying to speculate with live funds with a $50 account or a $100 account. And I get it. I understand. It's hard if you don't come from money, if you don't have the resources where you are globally. It feels like you're out of reach. Learn the skill set. Okay? I promise you, if you learn the skill set, you can do funded account type things as a venture, or find partners that'll come in with you. You don't need the money. It doesn't have to be your money. You can make a lot of money with other people's money. But funded accounts provide a way for you to go in with a very small amount of money, and you learn the skill set I'm laying down here in public. You can walk right into anyone's funded account challenges, okay, if they want to call it a challenge, and just walk right through it and take it over, and then secure whatever size account you're trying to go for, and then trade it soberly. Aim for 10% a month, 15% a month, and just make that and stop. Don't try to push it. Don't try to get rich real quick. You want that 10 to 15% a month coming into your hands after the split that you do with whoever that account is, you're registered with, whatever funded account company that's helping you find the scratch to get started. But knowing how to manage that drawdown will keep you from going into, obviously, blowing your account. It'll control the equity drawdown. It won't be a sharp, jagged falling off a cliff. It'll be, you run up to new equity highs, and you have a losing trade, which is reasonable. Everybody has a losing trade. You may have a series of losing trades. But if you take a 1% loss, and then you take another loss at half of 1%, and you take another loss at 1/4 of 1%, you're only down 1 3/4%. That's not a lot of drawdown. But you've now taken 3 losing consecutive trades. That's easy to come back from, versus taking 1% loss, then saying, okay, I'm going to double up and try to make it back with 2% risk, because I don't have to just get half of the position movement I took as a loss. And then you take a full 2% loss. Now you're down 3% on 2 trades. Then you go in again thinking, well, I'm going to do it again with 2%, or worse, you go higher, risking 3% or 4%. And then you use a stop, or you move your stop, opening it up with more risk, and then suddenly it's very easy to fall into 10% drawdown. And then it becomes a psychological wrestling match where now you feel embarrassed, you're shamed, you feel like you have to have it back, otherwise you're a failure. When professional money managers They don't care about being in drawdown. They care about managing their expectations and the discipline that's required to operate and engage. They are not allowed to touch their account when they're highly charged or emotional. So that's all part of risk management. It's not just the numbers game. It's a psychological game too. But you have to manage that and quell that whole desire to get right back to where you were before you took that loss. That feeling comes because you are an infant in this industry. And that's not a knock against you. Okay. It's the truth.